This conference will now be recorded.
Good afternoon, everyone. This is Kathy Neifeld with Agency One. It is Friday, May 8th, and we are going to focus today on the third of our weekly series on linked benefits. And today we are featuring One America with their Asset Care product. Our featured speaker is Ruth Fay, the Regional Sales Director from One America Financial, and our moderator is our one and only Ed Stark. I ask everyone that if they have any questions to please type them into the chat box, and we will get to them at the end of the presentation. And with that, I am going to turn it over to Ed Stark.
All right, happy Friday, everybody. Thanks for taking the time and coming on our call today. I'd like to welcome Ruth Fay, and Ruth is going to go through the Asset Care line and kind of break down a really, a little bit about the product, and then talk about a great sales idea that they have. And then, I'm going to turn it over to Ruth. If you have any questions, like Kathy said, please put them in the question chat box, and we'll kind of fit those in as we can. So, Ruth, I'm going to turn it over to you.
Great. Thank you so much. Can you hear me okay? Just want to make sure.
Yep.
From afar here. Great. Thank you.
Yep.
Good morning, everyone. And Ed, I really want to thank you and Kathy and everybody else at Agency One for having me on the call today. Really a exciting time, interesting time, but exciting time. Certainly we find that at this time we're seeing more and more people. They are really looking for protection, looking for safety, and really thinking about where their portfolios and where their retirement futures are at. And certainly asset care can be a big part of that. What I'm going to do today is talk a little bit, like Ed said, through, first of all, my background is 30 years in the industry, but the last 20 years in long-term care. And of that 20 years, I spent a bulk of my time in the traditional space. And I'm in my fourth year with One America. So it's been a really interesting an exciting transition to move to the asset-based products. They make a lot of sense to a lot of people, and for very good reasons. And certainly long-term care is something that's definitely an underutilized tool in your toolbox for retirement. So we certainly need to spread the word, and asset-based is certainly a great way to go. With that said, the Asset Care line, I'm going to talk specifically today about the design of the product, but then also more importantly, be thinking about clients of yours that might fit into with the qualified dollar space. We can do some very, very unique things with our product utilizing qualified monies like 401k, IRAs, 403bs, etc. I'll get to that in a moment. But first of all, with One America, we're a 140-year-old insurance company based out of Indianapolis with our home office. We have some of the highest financial ratings. If you're not familiar with us, we are a mutual company. We have a 95 Comdex rating, and we do write our asset care products on state life paper. So while our overarching company is One America, we do hold our licensure on state life paper. We do business in all states but New York. We can do business with a New York resident as long as they have a resident in any of the other 49 states. So we do some business that way. Many of our clients in the New York area also have a residence, possibly in either New Jersey or Florida, et cetera. So if you have any of that going on, we can look at that as long as they do have another residence. So the concept of asset-based long-term care, and where we'll differ a little bit from other asset-based products out there, is we really have two pieces to our puzzle. The one is our base policy, and the next part of it is our continuation of benefit rider. So the concept in our what we look at is a client has a portfolio of money, and they have it typically in a conservative, moderate, and aggressive positions in the marketplace. What we simply say to them is, why not take a portion of that money that you have, and in this case, it could be qualified dollars. It can be non-qualified, obviously. But we say, why wouldn't you reallocate a small portion of those dollars to gain not only additional leverage for life insurance and long-term care, and then how about if we add a rider that now would extend that even longer to give you lifetime long-term care coverage? So it's it's simply taking money from where you've already got it established, pocket A, I call it, to pocket B, repositioning that, And with that reallocation of those dollars, you gain leverage day one with the contract. You get a cash value. Obviously, it's a whole life contract on the Asset Care series of products. It's cash value. So if you decide you just want to cash out of the policy at any certain specific time, you certainly can, and there's a cash surrender value. It creates a death benefit day one, and that is, of course, a tax-free death benefit. It operates just like any other whole life policy in that realm. But then where it gets unique is that not only can you accelerate that death benefit for long-term care, we go a step further, and now you can jump into your continuation of benefit rider and extend that care for unlimited lifetime benefits. And again, all tax-free because it fits under the long-term care, for long-term care expenditures. The unique thing about how One America does this, we really have one product structure, and that's called the Asset Care. But what's unique about Asset Care is that we really can fund it any way the client, would like to. So just to give you an overview, when we redesigned and came out with sort of our new series of products in July of last year, we decided just to go simplify things and it's called the Asset Care because the chassis is the Asset Care whole life policy. And then we really just say to the client or to the agents, for your clients, we say to you, how are they going to fund this, this policy? So sometimes you're going to fund it with a single premium. Sometimes you're going to want to do recurring premium. So we just look at where the client is going to have the dollars coming from, and we can decide then how we can build this policy. Very flexible, which is really pretty unique. It's not just, it's a single premium, that's the only choice you have, and we move from there. So the thing I'm going to key in on today is the third thing down called the Asset Care Annuity Funded. And we'll get to that in just a moment. One thing to point out is that the Asset Care, no matter which version or which funding mechanism you use, all of these things are included. So the waiver of premium is included, and we've added 0-day home care. Used to be in the old world, if you've written our policy in the past, we had a 60-day elimination period for home care. When we redesigned everything, we cleaned all of that up, and we went to a 0-day elimination period for home care. And then it's an overall 90-day for any other sort of facility type cares, whether it be assisted living or nursing home. We do have some international coverage. It's pretty basic. It's just off the base policy, but it will pay some benefits from an international perspective. And then one thing to note, every single policy with One America is covered under our claims concierge, which is really what I call where the rubber meets the road at time of claim when the family really needs our help. And we have a team of folks that are very tenured, that have a lot of experience in this, because we've really been writing this type of product for over 30 years. This is not new to One America. We've had this accelerated type of policy from the life insurance vehicle for many years. So that also means we have a lot of claims experience. And with our claims concierge, one thing that's unique, when the client, their family calls in or they call in to start a claim, we'll determine if they are eligible for claim at that point. And if they are eligible for a claim, then we'll just see that all the way through. That one person is assigned to that case all the way through. They'll even help them if they aren't quite ready to receive a claim yet. They'll help that family through. We won't just drop and close the case. So they can, from start to finish, they'll have one assigned person, which is really unique. So how does this thing work? How do you get to the benefits? Well, most of our policies, or a lot of our policies, not all of them, but a bulk of our policies, and very unique to One America, is our joint policy. And the reason that's so unique is it's actually a joint second to die policy. So when the clients put when the premium goes in and we determine where that premium is coming from up front, the death benefit is established. That death benefit is a second to die policy if it's a joint case. From that death benefit, we then create the monthly benefit. And the way we determine the monthly benefit is we say you can either accelerate your death benefit at 2% or 3% of your death benefit. Now, with that said, then you go into adding your continuation of benefit rider. You can either double, if you will. For example, on the 3%, it would be a 33-month acceleration of the death benefit, and then you'd add an additional either 33 months. But where we really shine is that we offer the lifetime long-term care benefit. So you would add a lifetime rider on top of your 33 months acceleration. providing for that client. And by the way, in a joint situation, it creates a monthly benefit for each person. And those people, that person, one person could be on claim, or they both could be on claim. And if they're both on claim, no matter what happens, and as long as they're on claim, we would continue to pay benefits for each person. If we do have a single case, I don't want to leave this without letting you know we do a lot of single insureds as well. The only difference is they have one more choice on acceleration. They can accelerate at 4% of the death benefit. Otherwise, it works exactly the same as what you would see on the for the joint case. So the only addition is that additional 25%. Now, what I want to focus on today is the annuity-funded asset care. That is a single, we call it an annuity-funded whole life policy, because what we do is we literally carve out a portion of typically an IRA, 401k, 403b. We'll also work with non-qualified. For the purposes of a sales idea today, I wanted to focus around the qualified dollars. There's so many baby boomers out there right now that a lot of the bulk of their retirement monies are in qualified money. And so when we start to talk to them about a long-term care solution, they're kind of they meet us with, well, I really don't have a lot of extra money over and above my retirement funds, which are in qualified dollars. So for this, we typically focus on a 59.5-year-old to an 80-year-old. Of course, the 59.5 is important because we certainly don't want the client to experience the additional 10% penalty when they start withdrawals out of a 401k. But in this case, we would say that 59.5 to age 80 would be our target market, if you will, for this particular idea. And I'm going to show you a quick case study. And we're just going to take a couple of clients, and these happen to be two 60-year-olds, and it's Ron and Nancy, and we're going to be using qualified funds. These are retired folks. He was a retired Marine. Nancy was a retired teacher. They've been great savers. Of course, they have sizable IRAs, and they have high pension income. So what we're going to use here is they decided that instead of going to the federal long-term care, which he has access to through being in the military, they want to look at other options that have more guarantees in them, that have lifetime benefits, and that have guarantees of the premiums, which all of our premiums are guaranteed, no matter if you do recurring premium. And obviously in single premium, it's kind of a moot point because the clients would be paying one time anyway. But in this scenario, we're going to take $200,000 and they're going to carve it out of their qualified money, their IRA. We take that $200,000 from the IRA and we roll it over to an annuity with One America. And it's a deferred annuity. That transfer would take place tax-free. On that, in this particular case, on that qualified rollover, we would bonus that by 20% day one. So that $200,000 would then become $240,000 available to the client for purposes of funding a 10-year annual distribution into a 10-pay into the asset care. So we simply take that that 240 divided by 10, and we take 10 withdrawals or 10 income, it's an income rider actually, but 10 withdrawals out of that annuity. So that very first distribution, and I'm going to talk about that $24,000 for a second, because you're going to be saying, well, that's got to be taxable, right? So the transfer of the 200 to One America is not taxable because it's staying in a deferred annuity. It has to be like to like. It's all staying in that annuity. We bonus it by the 20%. The distribution of $24,000, when that comes out to fund the asset care, that's when we would then send the client that year a 1099 for the $24,000. So this is also an opportunity to spread out the taxes on this for the client. They only pay the taxes as that distribution comes out. But the day that first distribution is made, that $24,000, that creates a death benefit tax-free to them of $239,497. And they decided to add lifetime long-term care coverage. Now, what's unique about this with One America is you could take qualified money and move it into a SPIA, for example, and then funnel it in. You could do that on your own with different carriers and things like that. What we think is so unique is that we do this all internally. So once it's done, you set it and forget it. That $200,000, the paperwork, it rolls over to One America. It goes into a systematic then situation where every year then we just take another withdrawal from that annuity and funnel it into that asset care. And I'll show you in a second how that looks on an illustration. But here's how it sets up. So we chose a 3% acceleration. We added lifetime benefits. And again, these are two 60-year-olds. So they put in the $200,000. We gave them the 20% bonus internally. The 10 pay on the policy is going to be $24,000. Again, that created a $239,497 face amount. The annual long-term care benefit per person for lifetime benefits is $86,220. That broken down to monthly is $71.85. And if you were to go into the marketplace with $200,000 and need to draw off $86,000 per year, you would need a rate of return of over 43%. So we add the rider that's included in this package. The rider's included the 10-pay rider. Again, the annual long-term care, even on the continuation of benefits. So once you're through that period of the life insurance acceleration, now you're going to jump into the COB rider. That's going to continue to be $86,000 annually, or $71.85 per person for their lifetime benefit. So how it would look if you were to actually run this, and what I'd recommend is if you have clients that you know have qualified dollars where you think it might be pretty interesting conversation. I just did a presentation yesterday for a group, and one of the agents had a group of a client that fit this exactly, and we talked about how they could run an illustration that was specific to that client. But if you see how this really sets up on paper so that you can get more of a visual, the total initial premium, again, the first payment was $24,000. And again, that created that face amount. It also created then unlimited long-term care. If you break it down, I'm going to have you just concentrate on the premium portion of the policy on the left side, on the lower left side. Here's where I want to talk for a second. When you look at those premiums, we actually break apart the life insurance and the long-term care premium. So that $12,770 is actually what's funding the life insurance piece of this pie. So that's what's funding the $239,497. The $11,230 is what's funding, if you will, the lifetime long-term care. What's unique about that, if you have business owners, whether it be S Corp, LLC, self-employed, or if you have a C Corp, but even if you have an S Corp, let's say, they can write off a portion of that LTC premium. That is qualified premium in order under the LTC tax codes, and they can write off up to their age-based limit. If they're a C Corp, if you're working with somebody and the C Corp is funding this policy, the C Corp can write off that entire LTC premium because they have a true advantage when it comes to the write-off for LTC premium. But we have a tax guide that I can send to Ed and Kathy and all the folks at AgencyONE if they don't already have it for our 2020 tax guide. And I can get that to them so they can forward it out to all of you because it's pretty specific as to the age-based limits for this year. And that's a huge opportunity if you work with business owners. It's another conversation because they're always looking for something from a write-off perspective. So don't overlook that opportunity. That's a big one. The other thing I'll mention is when you go to the actual illustration, I like to show this because you can see how that $24,000 will funnel over 10 years completely over to the life insurance. So the clients would get a 1099 each year on that amount of withdrawal that we funnel in internally into the life insurance. But at the end of that 10th year, that client now has a fully tax-free benefit. And what I mean by that is that death benefit, of course, is tax-free. It pays out at second death again. So, and then the monthly benefits, whether it's one or both on claim, those monthly benefits are reimbursement benefits, so they are also tax-free to that client. So now you've taken a 401k or IRA dollars and funneled it over 10 years into a completely tax-free benefit for the client, and the client has spread their tax burden out over 10 years. I want to speak a little bit really quickly about if a client, let's do a couple of scenarios. Let's say a client goes on claim, one of the people go on claim. So let's say in the case of these clients, let's say he goes on claim first. So he starts taking $71.85 a month. We exhaust it all the way out. Let's say they exhaust their entire death benefit, the $239,497, and now they jump into the COB rider. Let's say then he passes away. So technically there's no life insurance left because he's accelerated that whole benefit. Is she out of luck? No. The answer is no, she's not, because that policy is still in force and she still has lifetime long-term care. So if she goes on claim at any point, that $71.85 will start paying out to her for as long as she's on claim. So it's definitely, when you think of it that way, the chances of 1 out of 2 people being on claim is so high. And this policy, the average claim, if they have a dementia or an Alzheimer's diagnosis, the average claim is 8 years. Is 8 years per our claims studies. And even in the best case scenario, when you look at a couple, there's a very, very high chance that they're going to have over a 5-year combined claim. So if you look at this, the lifetime benefit comes in. It's super important, and especially if you run into clients that have had some cognitive type issues in their families. Lifetime is really, really unique, and that's what really really takes us out of the crowd, because we're the only ones really in this asset-based world offering lifetime benefits. So that's really key, and the joint policy is great too. I also want to talk a little bit about some underwriting changes we've made. First of all, I'll put in. Let's talk about underwriting for a second, and then I'll tell you about some limitations that just went into place May 1st. First of all, underwriting for us, it's really a simple process because it's typically a phone interview. Unless the client has a lot of health conditions, we are very, very forgiving in the height and weight charts, and I've got it on a height and weight chart on the screen right now, so I'll give you a chance to look at that. So we're pretty forgiving on that. So what happens is either you can do an e-app, which we recommend, an online application, which we recommend because it's quicker and it's much more likely, less likely that you'll miss anything. Well, you really can't miss anything because it'll prompt you if you do miss anything on our online app. But also it's faster. But even if you do a paper app, basically when you fill that out, you just have to fill out part A of that paper app, and then we'll do a phone interview with the client. Or we don't, but LTCG is our third party that does that. So it's a pretty simple process for you. They're going to ask the medical questions. The height and weight charts are liberal. Also, we will underwrite certain things that other carriers maybe won't. We are different than other carriers in this space because we don't just pass or fail. We don't just say you either get benefits or you don't. We say, you know what, we're going to go standard through table 4 on this whole life policy. But oh, by the way, we actually will rate up to table 8. So if a client, especially in a couple situation, a lot of times you'll get partners and maybe one's super healthy and the other one just has some issues. Sometimes we'll get a decline with maybe you've gotten a decline with another carrier. We might be able to look at those people. So what I'd recommend you do is you work with AgencyONE and you work with Ed and Kathy and you get the pre-underwriting inquiry form, because that's really an important piece. If you've got somebody that's got some questionable health, I'd recommend you get to our underwriters ahead of time, give us a description of what's going on, and it can all be done via email. And then we'll come back to you with what we think, or I won't personally, but the underwriters will. And they'll say, given what you're telling me, we can probably take them. It looks like we could take them standard, which is through table 4, or we might have to rate it. So either way, we'll let you know one way or the other what we think we have to do. And I'm going to cover one more thing just so that you're aware of it, and then I'm going to open it up I'm certainly happy to answer any questions. As of May 1, we did make some temporary, and I want to emphasize temporary changes on our business limits for ages 70 and above. The idea that I just shared with you, we're still fine with. It's a single premium, even though it's qualified dollars. So the single premiums are still eligible above age 70. The COB and the base policy have to be single premium. What we're doing right now is we are suspending our recurring premium product. Used to be called Asset Care 4 for those of you who have written business with us. That's just 70 and above, and we're not declining them, so it won't look like they were declined. We're just postponing them. And so once we can turn this back on, then all we'll need is a insurability form that they have to fill out, that they are in a good health statement. So we're just, hopefully this is temporary. I don't have any timeline on that for you, but that did go into effect on May 1st. No changes really, 69 and below. So you're pretty safe, except for the fact that the 70 and above is fairly limited if you wanted to do, like I said, the recurring premium. I'm right at the end. I'm ready for some questions. So Ed, if you had anything else to add, or Kathy, or anyone else on the line, I'm happy to answer
the info,
questions.
Ruth. Yeah. So one of the questions that we have is one of the agents has a sister and brother-in-law that are retired military, and they still live in Germany, and he wants to know if they're still insurable and could they receive benefits living in Germany.
So the answer is they could receive benefits in Germany. They would have to purchase the policy here. That would be the challenge right now, is if they're actually currently in Germany. So the app would have to be signed in the States where they live. They have to have a residence in the United States. But once
they
you
have
get the
to
policy
qualify
in place,
Oh, I'm sorry. I was going to say, the benefits you have to qualify or be certified in the United States as well?
no, not necessarily. We would work with our claims area when there was actually, we would need to obviously get some information from whoever their doctor is in Germany. As long as that policy is in force. And I can get specifics, since that's a real situation, I can get specifics on what we cover for international. It basically comes out of the base policy, so the life insurance. We won't go into the continuation of benefits, so it's a little more limited as to how much we'll pay internationally. But I can get you the specifics on that.
Okay, great. And then the other is someone who enjoys the presentation, and they're going to ask for the slide deck and a brochure on this, and we'll get back to the agent on that. And then I guess the only other thing I wanted to say from a design point, because we've modeled quite a few of these cases, it is really flexible. I mean, you can design it with a single premium and then pay the continuation of benefits annually. You know, we've seen things like that. I like the way it designs personally. So it does have a lot of flexibility.
Yeah, you know, one thing that's kind of unique too, and that's a good point, Ed, thank you. One thing we added last year that we will allow now, it used to be we would get a lot of 1035 exchanges from other life insurance policies, which is fabulous. We love those. But oftentimes, if the 1035 exchange wasn't large enough to get the benefits that the client wanted, we would have to, it was really a manual, it was kind of a funny, we had to kind of play with it to get the right benefits. Now we've actually added a single premium drop-in rider where you can drop in a certain amount of money, and then if you don't feel like that's the benefits you want, now we can just figure out how much more the client would have to pay, whether that be a single premium or a recurring premium. So it makes it even more flexible if they've got some monies but not enough to actually get the benefits that they want in a lump sum. So we've added even more flexibility to it. Yes. So thank you for that point.
All right. Yeah, and I have one more question. It says, if the first spouse accelerates the entire base life insurance policy, then dies, then the second spouse accelerates up to her life, which is excellent. At her death, will any death benefit be paid out? Does it matter who went on claim or not in terms of the death benefit being payable?
No. So the answer to that is there is no death benefit left if the death benefit's already been accelerated, and it doesn't matter which person, because it is a true second to die policy. So it pays out at second death. If at second death, the death benefit's already been accelerated for long-term care, then there would be no death benefit to pay out. So that's true. Right. It truly accelerates the whole death benefit.
Okay. And then the last question we have is, if the client lives in New York but works in Connecticut, do they have the option of getting this policy?
I would love to tell you yes, but no. I've actually had that happen many times. We actually have to have a physical residence. They've been really sticklers on that. And that just has to do with the way New York, the rules in New York, because we are not licensed in New York. So if they're true residents, eventually we'll find that out, because all their doctor's appointments and all of that is usually in their resident state. So yes, they would have to have a residence, unfortunately.
Okay. Well, great. Well, Ruth, thank you very much. I really appreciate you taking the time with us today. And I'd like to turn this back over to Kathy. Thank you.
Thank you. Thanks for your time.
Ruth, thank you. Thank you so much, guys. I have a couple important announcements about next week, so I hope everyone will just hang in there with me for another minute or two. Sorry, my phones are pinging. Number one, Ruth, thank you so much. This was terrific. If anybody would like the slide deck We will make that available. If you've got any further questions about One America or any of the other presentations you heard this week, please reach out to your Agency One team. Next week is going to be a very unique week for us, and we're very excited about the presentations that we're going to be bringing to you. You all should have received our one idea this morning, which was a social distancing sales and survival guide. And on Monday, we are going to dedicate the 30-minute WebEx specifically to this social distancing sales and survival guide. And it's really all about tools and a roadmap to help the advisors with whom we work not only do more business during this pandemic time, but even after this is over. We're all going to be doing business a new way. And the 30 minutes are going to be dedicated to talking about tools that we have available to help you place business today and in the future. So if you think that your marketing needs some sort of accelerant in order to secure more clients and place more business, this definitely is the WebEx that you're going to want to participate in. That's Monday at noon. On Wednesday, we're going to be focusing on disability insurance. May is Disability Insurance Awareness Month. I didn't know if most of you had known that. So we're going to be presenting on Wednesday all about disability insurance with sales ideas and what you can do now to sell more disability insurance. And we're going to be doing that presentation in conjunction with our disability insurance partners, which is the Cohen Agency out of Chicago. And then on Friday, we're going to have another industry update, and our featured carrier on Friday is Prudential. And the featured speakers are going to be Kevin Brayton, who is the Executive Vice President of Life Sales and Distribution, along with Tom Farrell, who is the Chief Underwriter. So that is sure to be a very interesting and informative conversation. And my partner, Gonzalo Garcia, is going to be moderating the conversation with our friends at Prudential. Additionally, on Tuesday, at 3 o'clock. So there's a lot going on with Agency One next week. 3 o'clock on Tuesday, you all should have received an invitation yesterday. We are going to have our first deep dive Annexus training, and we are going to be focusing on the nationwide New Heights IUL product. Again, that's Tuesday at 3 o'clock, and you should have received an email asking you to register for that session. If you did not receive that email, please reach out to myself or to Lisa Mitchell or to Gonzalo, and we will make sure that that invitation is forwarded to you. That's all I have. It is just a little bit after 12:30, so I hope that everybody has a safe and enjoyable weekend. Again, if anyone at Agency One can help you with any of your needs, please let us know. And we hope to see you again Monday at 12 noon. Thanks, everyone.